All right.
And
All right. Recording has started. So let's go ahead
let's
and get going
go.
here.
Good afternoon, everybody. Thank you so much for coming today for our fall Zoom Power Hour lunch Zoom meeting. And I am Celia Cito with the Women's Council of Realtors, your 2023 president-elect. And I am going to introduce to us today Bob Wallace. He's coming from Evergreen Home Loans, and he's going to talk to us about everything you've ever wanted to know about reverse mortgages. A little bit about Bob. He's a veteran mortgage planner with over 18 years in the business of helping aspiring homeowners realize their dreams and seniors realize a retirement they worked hard for. He understands how many payments you made to build your dream. Robert began specializing in reverse mortgages about 7 years ago, then began to really focus on them because he believes reverse mortgages do make a difference. Robert was born and raised in Placer County. He's seen the change and growth of this entire area in California. So if you're looking to buy a new home, make home improvements, manage debt, or change your lifestyle, Robert and his team can help you choose a mortgage plan ideally suited to your needs and goals. Ladies and gentlemen, please welcome Bob Wallace.
Good morning. Thank you guys for attending, or you gals, or everybody. Let's just go with that. There's a few things that I do want to talk about. I'll try to give you some of your time back since we're starting a little bit late. I don't think this will take an entire hour, but there are some things, obviously, reverse mortgages in some people's mind are just, not a good thing, but that is from years past. I started doing reverse mortgages about 7 years ago and then really began to focus on them about 5 years ago, just because I never really had anybody cry at the close of an escrow, except when they do a reverse mortgage. So it's been kind of a good transition. It's really, it makes a big difference, and I appreciate what they do for people. And I love working with clientele that are not on their phone all the time. So that said, let's go ahead and get started. Again, my name is Robert. You can call me Bob. That's what most people know me by. And I'll just go to the next slide. So bear with me here. So reverse mortgages, how can they help you increase sales? You can help people get the house they really want. A lot of that is you can upsize somebody, and you'll see in some of the examples from a house that they're looking at that they're either paying cash for or putting a down payment on and having a mortgage. Or you can use a reverse mortgage and actually get more house with a reverse mortgage and not have a mortgage payment. The proceeds can be used as early gifts or retirement, inheritance. You can augment your retirement with them. They're so flexible, and this is the thing that I want to get into. Obviously, you're all real estate professionals. If you're not really focusing on the demographic of seniors, they hold the most wealth in America right now, and you'll see that in a graph coming up. The choices for them right now are watching this economy that we're seeing kind of go down the tubes. Not kind of it. We're seeing a lot of things happen. Obviously, you've seen it in the market. We're all feeling the pain, but they hold the demographic that has the money. So going forward, if you have a database of people 55 and older, you might want to start reaching out to them, because those will be the people, as we see real estate start to decline a little bit, those will be the ones that have the money, and they will be the ones with the equity that can purchase a home. So the demographics, as you can see, they hold over $11 trillion of this, and the wealth in America right now we're seeing is shed in the stock market and things like that. But the ages of people 65 and older, we're expected to double that by 2060. And I know that seems like a long way out, but the older I get, the younger all these numbers start to become for me. So a quarter of all home buyers today are 60 years old and older. So keep that in mind going forward. And the sources down there, you can see the source on the website. So keep that in mind going forward, and go through your database, start looking at people that might have the equity in their property to purchase with a reverse mortgage, because they're not only are they limiting their mortgage payment, they're using the equity they have to access their wealth. What is a reverse mortgage? They're called HECMs. It's a conversion of your equity into a loan. It's a negative amortization, if you will. That's kind of a negative term. But you can convert a percentage of your home equity into cash or a line of credit. We can get into that. FAR is Finance of America. They have a proprietary reverse mortgage, which is a home safe, which is really a jumbo. And the only reason that I included that in here is because I worked for Finance of America and Finance of America Reverse. And one of the products that they have has been really beneficial just based on the interest rate, the access to it, the qualifications, those kinds of things. The equity avail retirement mortgage, they're most of like reverse funding, Liberty, they all have these, but they're named something different. The equity avail is pretty much a generic term going across these mortgages, and they are for 55 and older. They can take their equity and turn it into a lower mortgage payment and then convert it to a reverse mortgage. That's a little bit more complicated, but this will give you an idea of kind of what you can do with a reverse mortgage and the age groups involved in it. So the benefit to you as realtors, you can produce more sales because you're dealing with a demographic that holds more money. You can increase your listings. They, look at people that are 62, 65, older, they have the wealth. You can increase your listings by them listing their house because they can use their equity that most of them hold right now to sell and then purchase on a reverse mortgage. Higher volume of home sales. You can work with home builders. Home builders also are, we can use this to purchase with home builders. You can increase the purchase power. And we'll get into some examples of that and what they will have funds required and left over. And you can market to various communities, which is really helpful because it just expands what you already have in your toolbox. So the comparison between the two, let's just look at both of them. There's no age restriction on conventional mortgages, as you know. Monthly payments are required. The equity increase or decrease in a conventional mortgage, it decreases. The liquidity decreases because you have a mortgage payment. The borrower owns the home. You pay property taxes, insurance, and maintenance, and then the risk of foreclosure if you don't make the payments. The contribution towards your payment, your purchase, depends on your qualifying. So you can use funds from retirement accounts and things like that, just like you can with a reverse mortgage, but there's an age restriction on a reverse mortgage. The nice thing about it is you don't have a monthly payment, but you can make one if you'd like to. The equity decrease as the loan balance increases, your liquidity increases. You do own your home. There are 3 requirements for a reverse mortgage that you have to make. You have to pay your taxes, you got to pay your insurance, and you have to upkeep the house. Those are just the only real requirements. Obviously, then some residual income that you have to be able to make your insurance payments and maintenance. The contribution towards your purchase, it just depends on your age. That's a critical factor in how much you have to put into the reverse mortgage to make it work and what your equity might be. And then you're able to preserve retirement funds, especially right now. The option with a line of credit in a reverse mortgage is a big difference because the line of credit actually earns interest at the same rate your mortgage does. And this is on an FHA reverse mortgage. It earns interest at the same rate as your mortgage rate plus a half a point. So when you look at the decreasing assets that we have right now with the stock market and people's 401ks going down, it's better to take money from an appreciating asset than it is a decreasing asset, because you double end lose if you take it from a decreasing asset. So if you can take it from a line of credit, which is called overfunding, and we can get into that. If you take it from a line of credit, you're earning interest on that line of credit, whereas you might be losing money in the stock market. And I hope that makes sense to everybody. Financial planning ability. And in my past life, I was a financial planner. The eligibility, these are just the properties that are eligible. They have to meet FHA standards in property, which we all have run into. It's pretty appraisals as far as conventional and FHA go, they're pretty much the same at this point. You know, you can convert an FHA loan to conventional, but you can't convert a conventional to FHA because of the appraisers. But it's single family homes, 2 to 4 unit properties, condominiums, and manufactured homes that are FHA approved. They have engineered foundations, and they have the tags. There's no wheels or axles on them. I'm pretty certain you guys have done a manufactured home at one time or another in your career. So, but they work. So let's just take, for example, you've got a 70-year-old couple, and these are not just for old people. As I was speaking with Celia, and the folks that in these pictures are their age, they have gray hair, but it's the demographic is not just for old people. Let's just make that clear up front. And I'm going to be on her advice changing this presentation a little bit. Thank you, Celia. So you have a 70-year-old couple in Arizona. They want to sell their home for 500 and purchase a new home for downsizing. They can pay cash, but they want to retain as much money as they can from their sale. So let's just go to the example. So you have you're downsizing with without a reverse for purchase. If you buy a $500,000 home, your cost to sell, let's just say it's 8%. You have $460,000 of net proceeds. The home price ends up to be $350,000, which is what they were looking for. Your funds remaining are $110,000. So you have that left over. And then you go through the same scenario. If you look at the bottom there, the funds remaining for the contribution of the sale to a reverse mortgage, they have over $245,000 left over instead of 110. They don't have a mortgage payment, which is the same as the other side, the downsizing without the reverse for purchase. And then you have over $100,000 left over by using a reverse mortgage for purchase. So you can see the benefit to keeping your liquidity. You increase your liquidity by using a reverse for purchase. And let's go to upsizing with a reverse for purchase. Same situation, different age, 70-year-old couple wants to sell their home for 500 and purchase a new home. They want to upsize a little bit. They don't want any mortgage payments. So let's just take a look at that scenario. Sell your home for 500. You've got $40,000 cost to sell. Your net proceeds are 460. Your home price for upsizing is 650,000. You're required to come in with $190,000. Now, if you use a reverse for purchase, you sell your home, you've got the same proceeds for selling your home. Your net proceeds, your cost to sell, your net proceeds are $460,000. You've got a $650,000 purchase price, all equal across both sides. Your reverse for purchase is $259,720, and then the contribution from the sale of your departure, you still have $67,000 left over. And your client, again, maintains their liquidity. Instead of putting money into the transaction, they have money remaining. I hope you all can see how that works.
I have a question, if I may.
Sure.
I don't know anything, about reverse mortgages pretty much, well, until right now, or I have a basic idea what it is. But my $1 million question is, okay, there's no monthly payment. When is the monthly payment? At what point is the monthly payment made? When the home is sold, or when, let's say, these folks pass away, the estate pays the balance? How I mean, because at some point,
So
you've got
let
to,
me make sure I
right?
understand your question. There is no monthly payment required. Are you talking about the balance of the mortgage paid?
Yes, yes.
There is no, these are non-recourse loans. So non-recourse means there is, once the requirement for refinancing or paying off the loan is when you sell, and when both of the borrowers, if there are two, have passed away or moved out of the house. If someone were to go, let's say that you have two people that go into a care home and they have a reverse mortgage, they are required to notify the reverse mortgage servicer to let them know, and they have approximately 1 year to sell the house. That is not a hard and fast rule. You can apply for more time if the home hasn't sold in a year. My father had one when he passed away, and it was in 2008 that we were trying to sell the house. So you can imagine how long it took at that point. He had a reverse on his home, and it took us almost 18 months to sell the home. So the loan has to be paid off when you refinance, and it's the same proceeds same way it works with a forward mortgage as it does with a reverse. You have a mortgage balance. You take the remaining mortgage balance and it's paid off with the sale of the home. Does that answer a portion of your question?
Yes.
Celia?
Yes, it does.
One of the
Yes.
other things that I want to bring up here that it's not in the presentation is you, your family can buy the home regardless of what it's valued at the time of sale. Let's say both borrowers pass away. At the time of them passing, the heirs of the property have the opportunity to buy the house regardless of what the balance is on the loan for 95% of the appraised value. So let's say your balance is 400,000 and the house is worth 200 when they pass, and that's what the appraisal comes in at. The heirs have the ability to buy the home at 95% of that appraised value. So there's some benefit there if they wanted to keep the house, or they can just walk away from it. And some people choose to do that. They choose to just let it foreclose. It's not affecting the people that passed, obviously. They just walk away from the home if it's upside down because nobody wants to buy it, and they just move on. Make sense?
Yes, thank
Okay.
you.
So reverse purchase for jumbo, you've got 57-year-old person in California, which this is a good scenario because California is probably one of the highest real estate markets in the United States, and looking for a property, let's just say $1.8 million. And we've got the scenario here, $1.5 million, sells his home, got $120,000 cost to sell on both sides. Net proceeds are the same on both sides. You've got the same purchase price. The home safe, which we talked about, would take $681,000 to buy the home and have no mortgage payment. But the funds required if you did a conventional mortgage to be able to buy that house would be $420,000. So you have $261,000 plus on the remaining side of funds remaining liquidity, but you have funds required of $420,000 on the other side. So hopefully you can see the benefit of this, and this is good for some people. And again, just a thought is a reverse mortgage is not for everyone, but you can see the benefit going forward and how you might be able to speak with some of your clients and let them know. And obviously I would be happy to talk to them and run numbers and find out what it is that they would be required or what they would left. It just really takes their name and their age and a few other details, and I can run scenarios all day long for you. Everyone all good with this? Okay. Reverse for purchase, multifamily, 62-year-old couple wants to buy a home. They want to do a rental unit from one side. Let's just say this is a duplex. It's really the same situations we've gone through, but let's take a look at what it would be here. So you have proceeds from the sale of a home. The duplex cost is the same. I'm going across the net proceeds and the funds required. You're going down to have a new mortgage. The new home price is $459 on one side, and the mortgage payment on the other is $955. You've got rental income of $1,500 of cash flow minus your mortgage payment gives you an additional cash flow of $505. So if you use a reverse mortgage, you have an additional cash flow of $1,500 because you don't have a mortgage payment, and then you have additional funds from the sale of the previous home of $40,000. On the other side, you have zero funds available from the sale of the house. So good for multifamily because you don't have a mortgage payment and you can increase your cash flow. So you're looking at pretty close to a $1,500 or $1,000 difference in what you would be able to have for liquid cash flow. Some things just going into it, you don't need to repay the loan until all borrowers pass away or leave the property, which means they have to be away from the property for 1 year. The mortgage company sends out a letter every year to the clients, and they are required to send that letter back that it's still being occupied as a primary residence. There is a requirement that you have an additional person or persons to send the letter to. If for some reason they're not getting the letter, they're not sending it back, they want to verify that that person is still occupying the home. This is part of the mortgage process. It can be paid through the sale. It can be repaid through the sale of your proceeds from a life insurance policy or refinancing the loan. And one of the things I do want to talk about as we go forward is refinancing into a reverse mortgage. There's no debt passed along to the heirs. Like I said, this is a non-recourse loan. There's nothing, your heirs are not responsible no matter what the value of the house is and what the loan balance is. It's just a done thing. There's no recourse. So I get questions about that. They wonder if the heirs are responsible, and I just want to make it very clear that they are not responsible. It's not a personal liability that goes to the estate. Once that loan is repaid or once it's sold off, it's gone. That's all there is to it. Any remaining equity, and this is a question I get a lot, is the equity in the property or what's left in the line of credit if they pass away, that is part of the equity in the house. It's the same thing as it would be with a forward mortgage. The equity is the equity of the house, and that is passed along to the heirs of the property. And the next one is the same thing I just told you. If there's a short payoff, they can buy the home for 90% of the current value with a post-death transfer. And that's all that is. It's based on the appraised value. No matter what the value of the house is and what the value of the loan balance is, they can purchase that home for 5% below the appraised value. Any questions on that? All good?
I have a question.
Okay.
So, if the home is now, if they bought it for, 400 and it's now worth 600, so they have equity, then, and the home appraises at 600, then the family members can buy it for 95% of the 600?
95% of the 600, and the equity in the property remains with the heirs. That doesn't go away. It's like I say, it's the same thing on a forward mortgage as it is on a reverse mortgage. The equity in the property is the equity in the property. So if the balance is $400,000 on the loan and the house is worth 600, there's $200,000 worth of equity minus your sale cost to do that. Does that make sense? All good?
Thank you.
Financial assessments. So there's you have to have a willingness to repay your loan. The qualifications are fairly simple. You can tell by looking at somebody's credit history whether they have a willingness to pay. And the nice thing about this is it's not based on your credit score. That really doesn't have anything to do with it. Like on a forward mortgage, part of your interest rate is based on your credit score. So you're penalized in your interest rate for your credit score. On a reverse mortgage, it's just what that interest rate is when it's locked. You have to show a willingness to pay, which means paying your taxes and your insurance. You have a decent credit history that you're willing to make your payments, and you have a rent payment history. They may do a verification of rents to make sure that you have been paying them. But for the most part, it's a very simple qualification process. They look at your income and your assets and whether you have the ability on a residual income basis, and it's based on the square footage of the house and how many occupants are in the house. So the square footage of the house, they use a formula for it, and I use a calculator on it, which we all do at this point. It calculates the residual income, and it's usually far less than what your income is. Even people on pretty much minimal Social Security can qualify for a reverse mortgage depending on their age. And it's all based on that. It's the utility charges, the taxes and insurance, and what your residual income is calculated to be, and that comes out as a percentage, and that's what you qualify on. It's a very simple qualification process. They're not easy loans to do, but the qualifying is fairly simple. Any questions on that one? I'm going to give you guys a bunch of time back if I don't get any questions here.
Yes, I have a question. It's simple. Why not easy loans to do? Why are they not easy loans to do?
Because they're complicated. They're complicated to put together, but they're not complicated to qualify. On my end, it's complicated. And I think the biggest part for me is being able to explain them. One of the things I didn't mention is that they do have to go through counseling. It's required. A third-party counseling is required because they have nothing to do with the mortgage company. They have everything to do with making sure that the client knows every question that they want answered about a reverse mortgage from a neutral party. Some of them will do it for free. Some of the companies will do it for free. Others will not. If you call around, you get your counseling list, you call around, some of them will do it for free. And then others, they charge about $150. But you have to have a certificate, which comes to me or whoever's doing your loan for you. And it says that they went through the counseling, and that's part of your submission package when you submit your loan. But that is a requirement. You have to go through counseling from a third party to make sure that I haven't influenced you, or whoever is doing the loan influences you or coerces you into doing something that you don't want to. And we all know there's a lot of fraud in the senior market, so that protects them.
That's good. We have a question from Tanya. She asked, what was the minimum age requirement again?
Depending on the type of loan that you do, Tanya, they go from 55 and up. A standard reverse mortgage, or a HECM, if you will, is 62, or they have to be turning 62 the year that they do this. It goes to the next birthday, so you could conceivably do it within a couple months of your 62nd birthday. But for the most part, you just think of it between 55 and 62. The proprietary products work at 55. The HECM, the standard FHA HECM mortgage, is 62 years old plus.
Thank you.
One of the other ways to use it is an early inheritance. What I find a lot of people doing when I do a reverse mortgage refinance is they're refinancing their home into a reverse mortgage to gift grandchildren a down payment for their first home. And that has been something that's been really beneficial to, I've been working with some younger clients lately that are, and fortunately, working with younger clients that are getting a gift from their grandparents. So they'll do a reverse mortgage on their house, and they pull out as much cash as they need for the down payment for their grandchildren. And you can also use it as an early inheritance. So some of the clients that I've had in the past, I haven't done one of these for a while, but they use it so they can see their grandchild use the inheritance while they're still alive, instead of just having, it passes on to them when they die. They are able to enjoy their grandchildren having an inheritance to go forward with their lives, and they get to enjoy seeing it. It's kind of fun.
Deborah has a question.
Go ahead. Question?
Okay, real question. I have a mother who lives in one of the lowest cost of living counties in the state. House completely paid for, but is looking to move out of state. It's really hard to find something even within that, because she's in Butte County and she's owned the home for, well, she hasn't owned it outright, but she bought it like 51, 52 years ago. What would you advise for her? Because she is on a fixed income.
Well, it'd really be the qualifications. I'd just have to run numbers for her, and it would depend, like, the house that she owns it outright. Is that what I heard you say?
Yes, she owns it outright, and she also qualifies for the special taxes in that county. So it's been a tricky thing for her to consider moving, because anything that would cost more, it's going to greatly affect her taxes.
Right. Well, it would just, I'd have to run it on what her proceeds would be, because she can use it to purchase another home and not have a mortgage payment. There are situations where we would do what we call a LISA if they don't qualify for the residual income to pay their taxes and insurance. What they would do is impound those. For the actuary goes out to 99 years old. And what they would do would be to take some of the proceeds from that property, use it for the down payment, and then take a portion of that calculated based on the actuary table, and they would apply that to her taxes and insurance going forward. So she wouldn't even have to pay those. It's just like an impound account on a forward mortgage, but it's collected up front. Does that make sense?
Yes, that does. Thank you very much.
Oh, you're welcome. Yeah, she might be a candidate for looking at it, because if she's looking to move out of state, and it could be that her tax base transfers with her based on her age. Do you know if she would qualify for that or not?
I'm not really sure. She is almost 77.
Okay.
But moving closer to family is one of the things she's considering, but also a place where she's comfortable.
Right. Right. We can take this offline, and you can give me a call and I can run numbers for her to find out. We could take, I need comps on her house presently and what that would sell for,
Sounds good.
and use those proceeds that way and just run it through and give you some numbers on it if you're, you want to do that.
That would be great. Yeah, thank you.
Perfect. This illustration here, I need to change a little bit. It's a little bit confusing. On scenario 1, if you're 62 years or older, have roughly 60%. The kind of rule of thumb is 50 to 60% equity in your property. You could eliminate your mortgage payment completely. And then on the other side, you could take cash and buy out another property. That's another thing that I didn't even mention, is that you can take cash out on a reverse mortgage and buy a whole nother property. You can buy a second home, you can buy an investment property, and have, depending on the cash that you get out, have roughly your little mortgage payment on an investment property. So that's another way for you guys to increase your business, would be to use a reverse mortgage to take cash out and buy another property and have an investment on the side. So that's kind of the end of this presentation. And what I would like to do is just chat with you briefly after this is, if you have any friends or family that could benefit from this, that you think we just talked about that, just let me know. Contact me via phone or email. The couple of things that we do, or most of the reverse mortgage that I've done recently are refinances of a reverse to a reverse, or people that have ARMs on their properties right now, the adjustable rate mortgages. So they're financing into a reverse mortgage, or they're doing a reverse mortgage to a reverse mortgage. And with the increase in property values that we've had over the last several years, they are able to replenish their line of credit. So the line of credit gets a little more complicated to get into, but the line of credit on a reverse mortgage is called overfunding. So if you have more equity than it takes to make the reverse mortgage work, it can go into a line of credit. And I think I discussed this at the beginning. That line of credit earns, and I'm not supposed to say tax-free, so I'm going to say you're not taxed on it. How's that? If you're not taxed on that line of credit increase because it's inside of a loan. So if you, let's just say you have a balance of 200 on the mortgage and you have 200 in your line of credit, you're actually getting ahead with your line of credit because you're earning, let's just say it's 5% on the 200,000 on your mortgage, you're earning 5.5% on your line of credit. And that money that you earn on that line of credit is not taxed. So it's something to look at. It is a really valuable thing, because especially like I was saying before, is as we're seeing the stock market and people's assets go down in their investments, you're guaranteed the rate on the reverse mortgage. So it's better to take that money from an increasing asset than it is from one that's declining. So you can supplement your income with it and not take it from a declining asset until that asset starts coming back. Then you can stop taking your assets out of the reverse mortgage and take them out of your increasing assets in your stocks or whatever your retirement situation might be, annuities and things like that that might be losing money. So that's all I have for you today. Happy to answer any questions that you have. And if you have any that you don't want to ask today, just feel free to contact me by phone or email.
This is great information, Bob. Anyone else out there have any? Stick them with the hard questions. Come on, everything you ever wanted to know about why people think reverse mortgage is a dirty word.
Well, can you tell us the bad scenarios at all that gave it that rap? Like a little bit more about that things.
Sure.
Because I have people that are like, oh, don't tell anybody I did a reverse mortgage. Realtors have said that to me. Okay.
Well, the perception is, and this comes from a long time ago, there's still information out there back from when reverse mortgages first started. And I think the first one was done when Reagan was in office. And at that time, when you ran out of equity, the bank had the opportunity, they could come and take your house because you were upside down. And apparently it did happen. A lot of what's happened since then is the stigma still applies, because some people did lose their houses. And when you look at taking something from a senior citizen, I mean, the optics on that are horrible. Since then, senior citizens 60, what is it? When you become a senior, is it 58 or 60? I don't know. I don't even look at it because I'm over that. is the stigma that went along with it. So since then, senior citizens have become a protected class, and the reverse mortgage has changed so much, but the publicity on the reverse mortgage has not caught up with that, if that makes sense. And some people still think they're for people that are desperate, and they are not. As a matter of fact, financial planners are going to be required to use a reverse mortgage as part of the retirement planning scenario. And one of the things that I would like to do, if you're interested, is we do financial planning webinars to show you how this works with a reverse mortgage and the benefit of using a reverse mortgage with your retirement planning. You will end up with more money at the end of it using a reverse mortgage than you would by relying on, I believe it's 4% withdrawal is what they want to do over your lifespan for your financial planning. And using a reverse mortgage, it actually, you end up with a lot more equity or liquidity in your life. And this is done all by a financial planner. This is with Finance of America Reverse Financial Planner. He's a great guy, and he goes into some serious detail on how to use a reverse mortgage to help your retirement and how it benefits you, especially just running the graphs, the visuals of it. It'll blow your mind. But the negative press, like you were saying, is really what hasn't caught up. The positive press hasn't caught up, but more and more people are advocating for these, and financial planners now are beginning to advocate for these, and they're going to be required to start using them as part of a plan.
Right. And because of that, because of the horrible things that happened to seniors back in the days, I think that's where the whole counseling, mandatory counseling came in by a third party, right?
Yes, that's exactly right. Because, you have, and we all saw predatory lending back in the 2000s. We saw people refinancing, and they was predatory. One of the things that they wanted to stop was the predatory lending, and especially with seniors, because a lot of seniors, they lose money when someone calls them up and tells them they're from the IRS and they give them all their information. And those are the kind of things that, as a neutral party going through the counseling, you can ask any question you want, and you can go back to the counselor if you have questions while we're in the loan process. You can go back to that counselor. So the stigma is going away. It's just taking a while, and some people, I think for me, as what I've seen is people that don't tell somebody I did a reverse mortgage because they don't want to deal with people saying, oh, what'd you do that for? But then the people that are advocating for them say, hey, I don't have a mortgage payment. This is what I'm doing. My change of lifestyle has been great. I've had clients call me up 2 years after they did their reverse mortgage, and they were taking their grandkids to Disneyland, and they didn't have the money to do it before because they had a $1,800 mortgage payment, and they just freed up $1,800 that they have every month. And this particular client that comes to mind first, she was able to have money in her line of credit that she could pull money out and take her granddaughter to Disneyland and stay there. So it's not just eliminating your mortgage payment, it's changing your lifestyle at times, because we all know some people that are pinched and they can't really do anything except support their house and their mortgage, and they don't have any life outside of that. So this truly is, and this is why I like them so much, is they truly do change your life. They make your lifestyle different. They're not for everyone. Some of them are expensive to set up, but it's not a short-term solution for something. It's something that you get into, and it's a long-term deal. And I just noticed a mistake on my presentation that I had put together for me. My phone number is 530, not 503. That's important.
I have a quick question because would you say, okay, here's a quick list. If you're like thinking reverse mortgages for me, because I know you've said a lot of these things, but can you break it down and go, definitely check on a reverse mortgage if your scenario is, or this is happening, blah, 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 blah. It's probably not going to be your deal if blah, blah, blah.
Yes, absolutely. And I'll tell people straight out, if it's not for them, then it's not. I can't imagine a scenario that it wouldn't be something not worth looking at. If whatever your situation is, I mean, I don't care how much money you have, it doesn't make any difference. It's still a financial tool. And that's why I think it would be really beneficial for anybody on here. If you want to, I'll send you an invitation to the next financial planning webinar that we have. it's really a good thing for you to see it coming from someone else. And this guy is a legit financial planner, been doing it forever, and he's employed by Finance of America Reverse to do financial planning. And it's a really good thing. But yes, the scenarios, I would tell people straight out, it's not for you. And some people, you know, there are people that don't qualify because they don't have enough residual income, or their age is such. At 62, it takes a lot more to make it work than it does at 70 or 72 or 75. The older you get, the less it takes, because the actuary tables only go out to 99 years old. Does that answer your question?
Yeah, that helps a lot. But yeah,
Okay.
I will absolutely be making sure, you know, she follows up with you.
Okay. Sounds good. Yeah, I'd be happy to help her. And I'd be happy to have you on the phone if you want to be there. You know, one of the things that's really important is, if there is family concerns, is that they see what I'm doing. It's completely, I'm transparent, sometimes to the point of a fault. I don't ever want it to come back on me. For one thing, I live in a small town. It used to be small, but you know, this industry, as big as it is pretty small. So if you get a bad reputation in this industry, you have a bad reputation, and it follows you. And I don't ever want to do that. It takes too much work to build a reputation, and I'm not going to destroy it by doing one loan that makes me a few $1,000s. It's just not worth it. And not only that, I would never risk my license, because every file that we do on a reverse mortgage is audited
By who?
by either the FHA or on the home safe and the proprietary products. They're audited, I believe, by I don't know the name of the organization. Somebody help me. There's an organization that audits the loans. Don't know. I'll find out for you.
Yeah, that's good. There's oversight.
Yes. Well, there you go. Thank
All
you all
right.
for attending. I
Great.
appreciate it very much.
Great presentation. Do we have anything else from the folks out in Zoom land?
No, thank you, Robert. This
You
is
have
Tobias.
Robert.
I do actually
Go
have
ahead.
an individual I'll be probably sending your way. I was actually texting her while you were speaking, so hopefully I will have somebody for you as well.
Well, thank you. I appreciate that. Yeah, happy to. And you know, if you want to be involved in it, if they're comfortable with it, please do. So they're comfortable.
Yeah, absolutely. And probably so, because she's a very particular woman. So I would imagine that she would want me on that call.
Okay, perfect. Yeah, happy to have it. The more the better to me, because then it just creates more, it creates trust. And that's something that's really important when you're dealing with seniors. It is one of the biggest things I find is creating that trust and not breaking it.
Absolutely. No, thank you. And I appreciate your time today. This was great information.
No, thank you. Appreciate that. Just remember, my phone number is 530, not 503.
I wrote that down. Yes, thank you.
Okay, I'm getting that fixed when we hang up.
Thank you, Bob. This
Thank
was
you,
great.
Stephanie. Yeah, nice seeing you again.
You too.
Thank you.
Thank you, everyone. We'll see you next time.
Okay, thank you.
Bob, stay on a minute. I'll stay
Okay,
on. And
will
I'll
do.
be